right-hand side table. So you'll find that there is one silver lining. The July to September quarter, the portfolio did deliver absolute good returns, 15% up, not only on an absolute basis, but also on a relative basis. It was better. Does indicate that the portfolio does have the ability to bounce back from the lows. Having said that, in the October to November months, it was still downhill for the portfolio. We'll cover what are the reasons behind that, the downturn in the returns again in the month of October and November. And the second perspective I wanted to share on the returns is, so this is a slide which breaks down the absolute share price return of the portfolio stocks into two broadly time periods. One is the near-term returns, that is 1 year, 3 months, 6 months, and a slightly longer-term return, that is the 3-year. And as you can see in the exhibits, you can witness a very stark difference between the longer-term returns and the shorter-term returns. So in the 1-year return, 3-year and 6 months column, you'll find a lot of stocks are in red. That is, they are down, they are negative returns. But when you look at the right-hand side table, the extreme right-hand side table, you'd hardly find just one stock which is in red. In fact, most of the stocks actually are delivered double-digit annualized return over a period of 3 years. So there is a clear divergence when we look at the 3-year return for the portfolio and when we look at the near-term return to the portfolio. And we will come into explaining a little while why the difference is so. But before that, we will also cover a bit of the Neotil-CHAMP's returns, where we have a little bit longer history of the portfolio. So Neotil-CHAMP's was launched in the month of August 2019, and we are just about closing on 3.5 years of Neotil-CHAMP's return. So Neotil-CHAMP's actual portfolio returns also you'll find the same pattern. When you look at the 1 month, 6 month, 1-year return, nothing much to talk about. But when you look at the 3-year return since inception numbers, the numbers are pretty healthy. And these returns are after adjusting for the expenses, after adjusting for the fees. You'll find that we are zeroing down almost 30% return on a 3-year basis, which is pretty healthy. So here also same pattern. When you look at near term, the last 12 months particularly has not been great for the portfolio. But when you look at a little bit longer term, take a little bit longer term time horizon, you'll see that the returns are completely different. And now jumping into what is impacting the portfolio return in the last 12 months. So broadly, two set of reasons again, which Pramod summarized. One is that some of the portfolio indeed there has been some headwinds around fundamentals in the last 12 months. But more importantly, we think that the market reaction to this near-term headwinds have been quite unjustified. It has been market has really reacted more than needed on this near-term headwinds. So first, to cover the near headwinds, what we are seeing in some of the portfolio stocks. So one is obviously the raw material price inflation, which has impacted mostly across the board, all the portfolio companies, and I guess across the Indian corporate landscape, this would have had an impact. So particularly among the portfolio stocks, alkyl amines, which raw materials are largely crude oil based derivatives, there has been a significant increase in the raw material prices. Also because it is a process intensive industry, also the power and fuel cost increases have contributed to impact on the margin. And similarly for Astral, Suprajit and Relaxo, where clearly the margins have got impacted because of the input price increases. And second set of challenges we have seen, particularly since the second half of last year, is few of the portfolio companies actually benefited because of the COVID during COVID time, because they got an additional stream of revenue during COVID. For example, Dr. Lal PathLabs in FY21 and first half of FY22, it derived quite a bit of revenues from PCR testing, as you know. But as COVID cases came off significantly since last year, third quarter, this stream of revenues has been coming down. And as we speak, I think second quarter, virtually it was almost nil. The COVID-related revenues. So this kind of a stream of revenue dissipated. Similarly for alkyl amines. So alkyl amines, ethyl amines benefited quite a lot during COVID. Also acetonitrile, it also saw an extra demand because some of these products went into COVID drugs like molnupiravir, like remdesivir, etc. And as you know that these drugs are no more in use now as they were a year back or year and a half back. And as a result, alkyl stream of revenues from especially from this COVID related, also kind of knocked off, particularly since the third quarter of FY22, December quarter last year. And third phenomenon is basically the inventory destocking. So as far as the commodity prices went up, they also saw a deceleration in the last 6 months. And there's been and I'll cover that slide separately, but there has been a sharp decline in the commodity prices in the last 6 months. So what has led to that? Dealers are destocking. Because one that they are carrying high cost inventory. Secondly, there is an also anticipation that the commodity prices will come off even more. And in that scenario, typical distributor dealer response is to destock basically. And particularly a couple of our companies have got impacted. One is Astral, because the PVC prices have come off so sharply in the last 3, 4, 5 months. So clearly, dealers or distributors are first trying to clear their existing inventory before placing an order on the new inventory. And second is Alkyl also. What we are hearing that the pharma supply chain is there is a lot of clearing off of the old inventory because these companies had loaded up on also on the non-COVID drugs in the previous years. So they are trying to clear off that stuff first before going into the fresh order. So these 3 set of challenges has impacted in the last quarter, second quarter, even in the last trailing 12 months of earnings of some of the portfolio companies that you can see in the red actually. The second impact on the second quarter result is, before going to that, at the portfolio level, you'll find that the EBITDA growth is still very respectable, double digit. So second quarter at the portfolio median level, which is the second last row over here, you will find that the portfolio earnings YOY are still up 13%. Last 12 months, the portfolio EBITDA growth was still up 16%. Right at the portfolio level, some of the stocks, decline in the earnings of some of these stocks have been more than made up by the growth in the earnings of other stocks.
So if you don't mind, I'll come in there.
Yeah,
folks, I think Ashwin is generally being conservative. He's giving you the 12-month trailing EBITDA figure. The first half of this year EBITDA growth, Ashwin, is more like 24-25%, right?
Yes.
Right. So folks, I mean, you can see what Ashwin is getting at, right? Once the COVID issues go away and the commodity price inflation ebbs off, you end up with the normal long-term EBITDA growth, which is closer to 25%. And already in H1, we've seen that. And in a way, this slide illustrates something that people keep asking us about. People keep asking us that, why do you guys show the names of your stocks? Won't other people copy you? And we keep saying that it's not easy to copy us. We can show you the names of these stocks for the next 100 years. And even then, 99 out of 100 people watching us will not be able to copy this because this is exactly why we exist. It's easy for us with our training to sit here and tell you that buy these great companies now. We are doing that for our clients. Buy these companies now. These are companies that have done well over long periods of time. Don't focus on that column. That column is irrelevant. Don't focus on that. It's easy for us to say because that's what we are trained to do. 99% of human beings will focus on this column. They will focus on this column. They will focus on the fact that shares are down 16% and they will not buy these franchises now. They'll wait for a Bhayankar rally and then they will buy the stocks. Ashwin Shetty won't lose too much sleep about this column. Ashwin Shetty is trained not to lose sleep about this column. And Ashwin Shetty will instead say, let's take an example. Ashwin Shetty will instead say that I know Astral Poly, Ashwin will say, I know Astral Poly better than most people in the country. I know Astral's competitive strengths. I also know that Astral's accounts are clean. I also know, Ashwin will say, that Astral has grown free cash flows 100x in the last 10 years and share price therefore has grown 100x. And Ashwin Shetty will say, this is an opportunity for me to buy Astral. Ashwin will lock into that and say, this is an opportunity for me to buy Astral. Ashwin will then ask the Marcellus research team to do some channel checks on inventory destocking in the PVC sector. And the channel checks will tell Ashwin that inventory destocking in the PVC sector has abated. In fact, now the restocking cycle in the PVC sector has begun. And therefore, Ashwin will say, I'm buying a proven franchise. I'm trying a proven franchise run by a clean, smart promoter with restocking cycle on the mend, and therefore he will load up on a Astral here and now. And there are many examples in this sheet of those sorts of companies with clean, long-term proven records of performance, but where the typical member of the public will not be able to buy because they will keep focusing on the share price. We will not focus on the share price. We'll focus on the fundamental corporate performance. And since we have good visibility on the growth of these franchises, we'll keep ramping up. So this is a lovely illustration. In one slide, you can see the reason for why we exist. You can see why it takes 10 to 15 years of training to become a Ashwin Shetty. Back to you, Ashwin.
Thanks, Saurabh. So you summed up very nicely. So basically, the point is that these are near-term headwinds. So ideally, the market theoretically shouldn't react, because 1 quarter, 2 quarter, or even 1 year for that matter, wouldn't play a significant role in the overall valuation of the company. But such is the nature of the market. There is always a kind of a knee-jerk reaction actually to the quarterly results. And that is the way, what has happened in the portfolio. But what gives us confidence to say that, these are near-term headwinds and the market is kind of doing a wrong thing is basically because this is something not new. In a corporate world, actually, corporate business headwinds are a part and parcel, actually. And even in this portfolio, for that matter, when we go into the history of these companies' portfolio stocks, there have been many such instances where we have seen the drawdown in the earnings and accompanied obviously by the drawdown in the share prices. And you can see that in the front of the slide. So many such instances. And this is not just restricted to COVID first wave, where virtually all the companies in India actually went through a period of no earnings and steep decline in the share price. Even beyond COVID first wave, there are many such instances, where there is a sharp decline in the earnings as well as in the share prices. And we draw lessons from that, instances. And remarkably, the portfolio companies, so typical business response to headwind is basically getting overwhelmed or a period of inaction. But what remarkably our portfolio company management do is that they actually see opportunities in these headwinds. And during this time, actually, they double down our investment. So we are given some of our instances over here. For example, Alkyl somewhat face a similar situation, what it is facing today. In a period between second quarter FY15 and third quarter FY16, a pretty long period, more than a year. But instead of cutting down on capex, plant capex, etc., it actually doubled down in the investment. So interestingly, it in fact increased the capacity in 2 of the products which were facing challenges around overcapacity at that point in time. That was methylamines as well as acetonitrile. And obviously, it also embarked upon operational efficiency, like bringing down the power cost. Again, very similar situation like today, it invested into solar capacities, solar power, invested into operational efficiencies. And this investment actually went on to become a cornerstone of Alkyl's success in the coming years, because now we know that acetonitrile has turned out to be such a huge success for Alkyl in the last 2 to 3 years. Had Alkyl slowed down on acetonitrile investment during that earlier period of headwind, it wouldn't have seen the success that it saw significantly. Similarly, Dahej, methylamines plant in Dahej turned out to be very huge success. It has been able to gain market share left, right, and center in methylamines in the last 4 to 5 years. Had it stalled the greenfield facility in Dahej because of the temporary overcapacity, we wouldn't have seen Alkyl success in the methylamines in the coming years.
And Ashwin, if you don't mind coming in there, folks, this is exactly what we look for in promoters. I told you what we look for in our fund managers. In our fund managers, we look for people who are unconcerned about share prices in the short term. Our fund managers, our analysts' job is to focus on the strength of the franchise, the underlying capacity of the franchise to deliver earnings. Our fund managers in turn, and Ashwin Shetty in turn, when he's looking at Alkyl, he's not looking for a promoter who's bothered about EPS या इस साल का share price movement. The entire engagement between our fund managers and the corporates we're looking at is, we're asking the corporate, are you playing the infinite game? Are you focused on the long run? Are you focused on creating wealth over 3, 5, 10 years, right? You'll never see a Marcellus analyst asking a question. You'll never see a Marcellus fund manager asking a question. Outlook क्या है? अगले 2-3 क्वार्टर में क्या होने वाला है? We are least bothered about अगले 2-3 क्वार्टर में क्या होने वाला है, because if we get bothered about अगले 2-3 क्वार्टर में क्या होने वाला है, we will not be ramping up on these franchises when they're in a downturn. We'll get scared like other people, sell the stock, and go towards some PSU stock or an annuity stock like Power Grid. Because our focus is on great franchises in the long run, we love promoters who build new capacity when the industry is going through a downturn. As Ashwin said, the fruits of Alkyl's boom over the last 3 years were laid in this 2015, 2016 slowdown, where the plant capacity they built 5-6 years ago, the plant capacity they built 5-6 years ago is what made them a star performer through the last 4 years. And once again, as Ashwin is saying here, they're putting up the next layer of capex, which will then sow the seeds for the next layer of Alkyls compounding. The fact that the stock is down, down what, Ashwin, 35% last 12 months?
Yeah, 4,500 to 2,700. Yeah, roughly 35%.
35%. That's at many levels, that's irrelevant, right? It's meant at many levels, Alkyl ka last 12 months ka share price is relevant. All that does is it gives us the scope to buy more, which Ashwin has done. As Alkyl has come off 35%, we know the firepower of the franchise. We load up. Our engagement with management is entirely about the strength of the franchise, the surplus you're generating, the cash flows, and are you plowing it back in to create more wealth for our clients 3 years out, 5 years out. Back to you.
Thanks, sir. So similarly, the case of V-Mart, to very quickly, again, a similar situation, rural and lower income group going through that challenges. So it faced that similar situation, somewhere in FY16 and 17. But again, V-Mart didn't go slow. It didn't cut down its investment. It continued its store expansion. I think it opened almost 17 stores on a base of 100 in 1 year itself in FY16. Similarly, in fact, forayed into new states like Bihar and Orissa. And very remarkably, it used the available employee bandwidth, management bandwidth that got free because of slowdown in business to focus on operational efficiencies. So again, similar to Alkyl, V-Mart's, what we now know that the working capital management is very efficient because of the tech-related initiatives. In fact, the start was made during that period. So they went on for vendor dedicated portals. We went in for inventory management systems. Again, during this period, actually, the success of the future years actually got laid down by V-Mart. Similarly, for Grindwell Norton also, there is a severe slowdown in auto cycle in FY13. And at that point in time, Grindwell derived a lot of revenues from the auto sector. But instead of slowing down its expansion, it doubled down on its investment, put up capacities in the abrasives, but more importantly in other segments like refractories, etc. Also invested into R&D arm through co-investment with the other Saint-Gobain associates. And now we have seen, like in the last 2 to 3 years, despite so much slowdown in the auto sector, Grindwell number have been very resilient because now their business is diversified beyond abrasives. So abrasives now constitute only 35 to 40% of their revenues. 60% of its revenues come from other segments like performance plastics, refractories. Again, had Grindwell slowed down in its investment, we would not seen the resilience shown by Grindwell in the last 3 years. So that is what we like, as Saurabh said, management who show very resilience, who don't get bogged down by the situation. In fact, they stay the course and in fact double down on the investments. We have seen that what ultimately translates is that as things normalize, not only the earnings.
We should also add, Ashwin, we get very worried when the management team is also staring at the share price, right? Because I don't think I've seen a Virat Kohli innings where staring at the scoreboard was the reason for Virat Kohli's success. If you could score runs in cricket by just staring at the scoreboard, as many management teams do, they're very conscious of the share price. If that's all it took to build a great company, staring at the share price, staring at the scoreboard, then I don't think there'd be so few great companies in the country. The reason the sorts of companies we've invested in across our portfolios generate fabulous wealth over 3, 5, 10 years is because they don't stare at the scoreboard. They're least bothered about the share price. They're focused on the dhanda. They're focused on comparative advantage, ROCE, generation of surplus, reinvestment of the surplus, regardless of external circumstances. And as I was explaining in the preceding slide, it's the ability of fund managers like Ashwin to buy more of these stocks when the rest of the world is running away from them for whatever reason, war in Ukraine, input cost inflation, etc. It's that ability to buy the more of great franchises when other people are running away that defines Marcellus. It's it's simple to explain to you guys, but it's not very easy to do. Were it easy to do, other people would also be doing it. But as we have seen over the last 5 years, there are very few management teams and fund managers who think like this. Back to you.
Yeah. And the result of this management resilience is that these companies, as the things normalize, the earnings recovery is pretty sharp. So it is not only recovering the decline, but in fact, they go on to make new highs. And similarly on the share price return, as you can see in the second last and the last column, these are pretty punchy numbers actually. So this is the kind of the recovery. And hence, over a 3-year period, so 1 year may be down, but the recovery over the next 2 years means that the 3-year period return generally for these companies are pretty healthy, and so is the share price return. And we believe that, just to sum up, this is kind of so earlier we talked about only 12 months period, but when you look at the long-term earnings of these companies over the last 10 years across different time periods, you will find that cross cycle, the earnings are pretty healthy. So in fact, I can't see any stock here which has negative number in the EBITDA column actually, for that matter. Even though, for example, FY19 to 22 has been one of the most challenging periods. Even in that column, there are some companies showing single-digit EBITDA CAGR, but there is no company which is negative. The reason is simply that because these companies are able to face headwinds by taking it on the chin, invest in the business, and they are able to recover more than they are lost. And hence, when you look over a 3-year time period, the earnings are pretty healthy. I'm sure that when you zoom in into these companies in the 3-year time period, there'll be very ups and downs. But when you look from a 3-year time period, the recovery is pretty fast, and hence the numbers are pretty consistent, pretty healthy. Whereas when you look at the BSE 500 numbers at the bottom row, you will find that there is significant stark differences. So across different time periods, there is at least when you look at again at the EBITDA column, the cash flow, the difference would be even significant. But when you look at the EBITDA column itself, there is 8 to 10 percentage points difference, divergence in the performance of our portfolio companies versus the broader market. That is simply because how these companies react during periods of downturn. That makes the difference. So similar for Little Champs. And why we are pretty confident again this time too is that one is drawing from the experiences as I talked about, but also a couple of things. One is that the headwinds itself are abating. So commodity prices, as I said at the beginning, we have seen very sharp correction in the commodity prices in the last 5 to 6 months. So anywhere between 30 to 60%, there is a correction from the peak commodity prices we see. So far, we have not realized the benefit of that in the first half because these companies carried a lot of inventory at FY22 end. Because the COVID situation in FY22 end was still, it was still there. Similarly, the frenzy surrounding Russian-Ukraine war was it at peak. Now it got used to it. But in the month of March, there is a lot of frenzy surrounding geopolitical situation. And as a result, the portfolio companies loaded up on inventory at that point in time. And obviously in the month of March, it was a very high cost environment at that point in time. And hence, when you look at the bottom right-hand side table, for many of the companies, the inventory actually, March end inventory accounted for pretty significant percentage of the total raw material consumed in first half. So as a result, we couldn't fully realize the benefit of the commodity prices. But as we go ahead, we think that this should start reflecting in the margins of these companies. But more importantly, where we are more gung-ho rather than on the near-term raw material cost and margin is the kind of investment that these companies have made in the last 12 to 24 months. Again, we have talked about this in the past, but good time to reiterate. So many of the companies have doubled down. So it's not only a kind of a phrase I'm using, actually in actual numbers also, they are doubled down in the investment. As you can see on the right-hand side table, bottom row, the median investment by the portfolio companies was more than 2x than what they used to do in, say, a normal period, FY19 to 21. FY22 May, the investment has actually doubled through a combination of both organic as well as inorganic. As a result, for example, some companies, their entire addressable market has actually expanded significantly because of this investment. For example, take the case of Dr. Lal Path Labs. 2 to 3 years back, it was largely present in North and East India. Last year, it acquired a company, Suburban Diagnostics, based out of Mumbai. And now it has got an entry into Western India diagnostics market. Similarly, GMF Folder, from a single product, single country company 4 years back, Now it is a multi-product, multi-country global company, and hence the addressable market has increased multifold. Similarly, for most of the names over here, the kind of investments, forays that these companies have made in the last 2 to 3 years, it gives us a lot of confidence about the growth runway for these companies for the next 3 years, 5 years, even for some companies for the next 10 years. So this is one kind of single data point which makes us very gung-ho about the future of these companies. Similarly, for the retail champs companies, many companies have expanded geographically. Many companies have expanded horizontally into new products. Again, the growth runway for here has expanded significantly, courtesy the investments that these companies have made in the, particularly through COVID. And hence, we are very confident very sanguine about the fundamental prospect of these companies.
Ashwin, if you don't mind, I'll come in here again. So folks, what Ashwin is telling you that this is announced capex or announced acquisitions, right? This is as per the FY22 annual reports, and as he's showing you in this final column, right? If you look at the step up in capex that these companies have announced, and remember these are companies with proven long-term capital allocation track records, right? It's not as if suddenly the Kotharis awoke one morning in FY23 and said, "Aaj capex karenge." They've been running alkyl amines since 1925, and they've got a stellar track record of long-term capital allocation. Similarly with the Shahs and Fine Organics, and similarly with the Tarak Patel and family and GMM and so on and so forth, right? Sutrajit and Ajit Rai's family. So you're looking at some of India's smallest small cap capital allocators, and they are telling you as clearly as they can that they are putting more money to work. They're setting up new plants or acquiring businesses. Now the benefits of this obviously will take 2 to 3 years to come. You can't sort of announce capex in year T and feel the benefit in T+1. It will take a couple of years to come. And as night follows day, when those benefits come and these shares are 70-80% higher, rather than having 220 people on the Zoom call, when these shares are 70-80% higher, we will have 550 people on the Zoom call, right? That's typically how most investors process information. Rather than understanding the track record of a company, the strength of the franchise, rather than appreciating the quality of capital allocation and saying, I can see this is a compounding machine. They are generating surplus. They're announcing the reinvestment of the surplus. Let me load up now. Most people tend to wait for the results to fructify, for the shares to rally 80%. And then so when that happens, as you would have seen in the past, there'll be 500 people on the Zoom call. And that's why this journey is so hard. That's why this is what makes stock market investing difficult. The ability to understand the franchise's strength, read the financial statements in the right way, load up before the capex cycle results fructify, and then benefit from the hard work that the management team, the promoter, has done in growing and taking a small company and making it a much larger company. We've lived through this. We've seen, for example, Garhware Technical Fibers and Vayu Garhware do this for 6-7 years. We used to own it even before we set up Marcellus. We used to own Garhware Technical. In our erstwhile avatar, it was called Garhware Wall Ropes. I used to own it in my personal portfolio then. We've seen alkyl amines do this in our erstwhile avatar. We've known Suneet Kothari, Yogesh Kothari ji. We've seen them do this for 6-7 years. We've seen GMM Pfaudler do this for 6-7 years from our erstwhile avatar, and so on and so forth, right? You can hopefully you're getting the message that I am trying to relay to you. You assess the cleanliness of the company, the quality of capital allocation, the strength of the franchise, the surplus that emerges. You check to see that the surplus is getting reinvested. When the announcement is made and the factory is getting set up, you load up rather than waiting for the fruits to come through, because this cycle will play out decade after decade. And if we stay patiently invested, we will get greatly enriched, as we have done in LCP, where I think in the last 3.5 years, Ashwin, LCP is compounded at what, 28-29%? 28%, and net of fees, for those who are interested, net of fees. That's why I'm trying to explain to you in simple words why this is a difficult journey to go through. All the information is out there. It's as available to you as it is to us. But the ability to understand that information and do the right thing psychologically is tough. Ashwin, back to you.
Thanks, Saurabh. And we are going on to one question. I think somebody has whether we are paying too high price for these companies, and as a result, that could have been a reason why the stocks have not done well in the last 12 months. So no indication basically. So I think you heard us before, talking about how we use price to free cash flow as an indicator whether a company has become expensive or not. So this is basically since FY17 to FY22. And the green is basically where the price to free cash flow has not changed materially or significantly between FY17 to 22. You'll find that for most of the companies in the portfolio, it's a green signal indicating that on price to free cash flow, these companies have not increased significantly between FY17 to FY22. In fact, for some of the companies, the price to free cash flow multiple has been lower actually to what it used to be in FY17, indicating that they have become cheaper than what they used to be in FY17 and what they are in FY22. So for a couple of companies, obviously there is a red mark. For example, Alkyl Amines, GMM Pfaudler, Grindwell, where even on price to free cash flow, these companies are trading higher than what they used to be around 4 to 5 years back. The simple explanation for this is that Alkyl Amines used to trade in single-digit PE in FY17, despite making ROC of north of 20%, despite good numbers. So obviously, for some of the companies, there is a discovery element which has led to re-rating. But also because of the fact that these companies have undergone significant change in their quality. Just to take an example of Alkyl Amines, 5 years back, most of its revenues used to come from ethyl amines. But courtesy, I talked about ethyl amines expansion because of acetonitrile expansion. Now it is a much more diversified portfolio, right? So the company is much more diversified than what it used to be around 4 years back. Secondly, Alkyl 5 years back used to generate an EBITDA of 40 to 50 crores, roughly speaking, per annum. Now it generates, even in the last 12 months downturn, it has generated more than 200 crores of EBITDA. So this step up in the EBITDA generation opens up immense possibilities for the company. So Hitarto, because of its small cash flows, it couldn't go beyond the amines. But now because of the large cash flows, it can actually target much beyond the amines. So as you know that pharma intermediates, agrochemical intermediates is a vast market. Now because of this huge cash generating change which has happened, it can target much more beyond amines. Furthermore, the business is also more institutionalized now. Their R&D team is more than 50. There is second generation involved in the company. So the longevity and the growth of the cash flows, which the perception which was there 4 years back, now there is a significant change in that perception because of the institutionalization, because of the increase in the size of the company and so on. As a result, there is a justified increase in the multiple of the company and hence the intrinsic valuation. I hope I made the point. So for similarly for Grindwell, much more diversified. Talked about 5, 6 years back, large part of their revenues used to come from auto sector, but now around 40% of their revenue only comes from abrasives segment. So 60% is non-auto dependent and so on. So there is a step up in the quality of the companies, size of the companies, the level of institutionalization of the business, and hence the longevity and the growth of the cash flows of these companies. And hence there is a deserved re-rating which ought to happen in these stocks. And hence we are not bothered about the red signal, particularly on these stocks. And just to cover off last part, so we talked about all nice, but what are we trying to benefit from this dislocation is that we are loading up on the stock as Saurabh talked about. So in the RG portfolio itself, we have bought loaded up in Dr. Lal and LTTS, two of the stocks which have seen the significant correction in the last 6 months. And to some extent, that has paid off also. So for example, in Jan to June, Lal and LTTS saw significant decline in the share prices. But the bounce back in the July to November has been pretty good. And our action has actually contributed to the returns of the portfolio. And that is where the market behaves on the left-hand side chart, as you can see, like the market behavior in the short term typically ranges in 3 kind of scenarios. One is where the market is not touching any stock because it is low liquid story, not well known, or there is a lot of negativity surrounding these stocks. And on the other hand, there is some stocks, which there is excessive optimism, etc. So our job is to find stocks where they're falling in which quadrant or which kind of, and try to take suitable portfolio action. So most of the RG and the LCP companies, I believe, will be falling right now in the kind of the left-hand side of this chart, and we are appropriately increasing the position, trying to benefit from this market dislocation, increasing the position in the stocks. Hence, we are quite in summary, we are very gung-ho, very confident about the earnings growth of these companies for the next 3 to 5 years, and similarly, the share price returns for this portfolio. Saurabh, you want to add anything?
Yeah, I was just going to say that, look, folks, we have actually no idea what will happen to the share prices in the next 12 months. So as Ashwin explained, right, we loaded up on Dr. Lal across our portfolios in RG and also in CCP through June, July, August. Right, we didn't know that Dr. Lal would recover in the second 6 months of the year, and it has staged a bit of a recovery, and even now we don't quite know what will happen to Dr. Lal in the next 12 months in terms of share price action, right? And just using Dr. Lal as an example, what we do know is that relative to competition, this company's capital allocation, its systems and processes, its quality of management, the strength of its competitive advantages are on a different level altogether. And they've proven this over very long periods of time. And this is a point we can validate by talking to, say, 40 clients in our client, 40 clients who are doctors in our client base, and another 10 path lab owners who are our clients, right? Across Marcellus' pan-India franchise, we have now around over 10,000 clients, of which 30 are doctors, 10 are path lab owners. And detailed discussions with these 40 people over several years has given us lots of visibility that Dr. Lal stands head and shoulders above the competition. And therefore, when Dr. Lal corrects 40-50%, as it did in the first 6 months of the year, across Marcellus, the various fund managers start loading up on it. Whilst we don't know when the share price will bounce back, what we do know is the franchise is so powerful that if we behave like this, we will get fruits in the longer run. The typical investor who's watching will do the reverse. They will wait for Dr. Lal to rally for 2 years, and then they will load up. And we understand that. We understand that, everybody's a human being. If we try to do what many of our clients do, many of our clients are, say, doctors, right? If Ashwin and I tried to become a doctor, obviously it would be a disaster. And similarly, if our clients try to pretend to become fund managers, that will also be a little bit of a challenge. So each person brings skill sets to bear in their profession. The skill set we bring to bear is assessment of the integrity of a promoter. Is he honest or is he a chore? Assessment of the strength of the moats, the strength of the franchise the promoter has built. And the third skill set that we bring is when other people are losing their nerve, they're losing their shirt, they're losing their calm, that's when an Ashwin Shetty ramps the position up when other people are running away from that stock. Back to you, Ashwin.
Thanks, Saurabh. Pramod, over to you.
Thanks, Ashwin. Thanks, Saurabh. So let's address the most frequently asked question. Ashwin is smiling, but I think, Ashwin, there's a more frequent question asked about, is Little Champs open for investment? So I'll take that question. So look, if you're an existing investor with Marcellus in any of the other portfolios, you can reach out to our client support team and your RM and leave your interest with them, because as you know, we're very, very particular about the liquidity in Little Champs. We don't want to take more money than we can manage given the liquidity constraints in these stocks. And therefore, we only allow investors to come in as and when an existing investor redeems, right? As and when there is a place, we let new investors come in, so that we can reach out to you when that happens. If you can leave your name and contact details with our client support team. If you're not an existing investor, you can write into sales@marcellus.in, SALES sales@marcellus.in, and leave your contact details with your expression of interest for the Little Champs portfolio. As and when we have capacity, we'll reach out to you. But the strategy remains closed given the liquidity constraints, like we first highlighted when during the launch in early 2020. Now, the second most frequently asked question, Ashwin, GMM Fodler, looking at the sort of questions that are coming in, looks like there's a grave misunderstanding in terms of what's happened with the company in terms of promoters exiting. I think there's some element of irresponsibility on behalf of the media to have quoted that the promoters have sold. Can we sort of take people back to square one and help understand what are the changes in the ownership structure in this company, and why we should not care too much about the share price fall?
Yeah, sure. So one is regarding the promoter exiting. So GMM, around 3 years back, used to be owned 51% by DBAG and around 24% owned by the Patel family. So DBAG, everybody should understand, it's ultimately a private equity firm. And private equity is a kind of comes with a limited shelf life, so they have to exit anyways. So DBAG exiting, we think doesn't make any difference. Whereas actually Patel family stake have in fact increased in the last 3 years. So from 24.56 March 2020, it's around 24.18. Plus the recent press release, they have agreed to increased it 1% further. So they will be buying 1% from DBAG. So in fact, I would say the strategic promoters who actually run the company, who are responsible for the management and capital allocation decisions of the company, they are pretty much in the company. They have not trimmed their stake. They in fact slightly increased their stake. So that is one. I think DBAG is a private equity firm. Second is that the business fundamentals of the company have been pretty strong over the last 3 to 4 years. So as you can see on the numbers on the left-hand side, on every parameter, actually, they have posted very strong results. In fact, if one analyzes first half, it should be FY23. Sorry for the mistake, last column. In fact, if one analyzes first half number, then the growth will look very phenomenal, actually. So the fundamentals of the company.
Also augment that with, a lot of people in our country sort of say wild things, and I think it's a national habit to say wild things, right? 73 crores, let's simplify it, 70 crores of profit. As Ashwin is saying, if you annualize the current year, you're coming in at 360 crores, right? So this company has grown profits 5x in 5 years. 5x in 5 years. And this is real profits, because we speak to a range of pharma companies and specialty chemical companies who repeatedly have told us over the last 3 years, including as recently as 2 weeks ago when Ashwin and I went to the interiors of Gujarat, that this is a full order book. This is a full order book, so full that there is simply no room for GMM to take more business. So it's not as if this PAT or PBT is some sort of number which has been fabricated. These are real numbers, real profits on the back of 5x growth in profits in the space of 5 years. This company is compounding nicely. The private equity company that invested, I think DBAG came in, Ashwin, 7-8 years ago?
Yeah, December 14, 8 years.
So 8 years ago, the private equity company's fund life is ending. Naturally, they are exiting, and they flagged this. They flagged this clearly when the GMM Fodler Wala deal took place in August 2020. When that deal took place, they made it clear that over the next 3 years, since the fund life is ending, they will exit the position. They are gradually exiting the position, the German private equity firm, and in their place, reputed foreign investors who we know for many, many years, high quality foreign investors, fundamentally oriented foreign investors manning large pension pots in the Western world are coming in. So to our mind, this is going exactly as it should. Dominant franchise, glass-lined reactors, generating a surplus, reinvesting the surplus to grow the business, as evidenced by what you're staring at on the screen, 5x in 5 years. A private equity company helping the company with helping GMM with a certain phase of its growth, then the private equity fund company exiting as its fund life in Germany expires, and high quality FIIs coming in. That will improve liquidity in the stock. Lack of liquidity in the stock was one of the things which had held us back from building a better position. So as these new wave of FIIs enters GMM share price, if the stock becomes more liquid, then so much the better. Then people like us can consider upping the position size up.
Yeah. So not only the quality of the fundamentals have been good, but even the business itself has improved significantly. So now, as I said, like GMM Pfaudler is a global business. Also, technology now is secure because GMM India now owns its erstwhile parent. So technology is secure within GMM India, which is not the case around 3 to 4 years back when GMM was a subsidiary of the parent. And any flip to competitor at the parent level could have adversely impacted GMM India. But now GMM India itself owns the erstwhile parent, and hence the technology is also secure. So significant impact in the improvement in the numbers as well as the quality of the business in the last 3 to 4 years.
Yeah, just 2 cents from my side. I've been on the sales team in the sell side to offload 17% of a firm's equity at 11% discount to the current share price after a sharp share price run up is actually remarkable. And Saurabh said, even more remarkable is this sort of entry into the shareholder register, the quality of investors, the quality of foreign investors entering in. So if at all, I think the takeaway for investors from this is there's a lot of demand for this stock from the investor community. And unsurprisingly so, given what you're staring at on the screen in terms of the stellar fundamentals here. So just as an ending line, promoters haven't sold in this transaction. The promoter stake is only gone up in this transaction as well as the transaction that happened a little over 2 years ago. By the way, there is still another 13% that DBAG owns, which will likely be offloaded anytime soon, whether in the next 3 months, 6 months, 1 year, we don't know. What we do know is that's also part of a fund that has to return money to its investors, and therefore at some stage they will exit. Another 13%, given that the market could absorb 17%, we wouldn't be surprised that there will be takers for this. But anyway, that's besides the point. We will remain focused on fundamentals, which Ashwin has talked through, and as you see on the screen, remain robust. So moving on to the next. Amrutanjan as a stock in terms of where it stands, what are the issues that we see in fundamentals, and where we can see a turnaround of sorts.
Okay. So Amrutanjan, again, it's because of the COVID-related revenues tapering off. So pre-COVID, Amrutanjan balm segment used to clock around 8 to 10% growth. It's a mature segment, but Amrutanjan is growing slightly faster than the market because gaining market share. Predominantly, its balm revenues come from southern India and eastern India, gaining market share in north and west. But during COVID period, there was a spike in the revenues because people used to also mix balm along with the water while taking steam. So there is a clear uptake in FY21 and first half of FY22. Now that COVID is behind us, so the growths have moderated to the long-term numbers of 8 to 10%. Optically, the first half, the number looks bad because we are comparing on a high base of last year. But when you compare first half of FY23 with a more normal year like FY19 or 20, the growth is still around 8 to 10%. So it's nothing. Headline numbers look a bit bad, but it's nothing abnormal. The growths are come back to the normal levels. And also company had some company specific issues in first half because they they had some supply chain issues in their ORS segment and so on. But nothing structural change or damage in the company. On the other hand, on Comfy segment, they continue to do well. As we speak, the revenues from Comfy is nearing an annualized run rate of 100 crores. So they have done very good headway in certain states like Orissa, etc., where I think they are already in the top 3. So on Comfy, the progress is pretty strong, and we think that Comfy is now hitting a very critical level where it will start generating profits for Amrit Anjan. So far, it has a very small size, so there was no operating profit generation. But as it now crossing or nearing 100 crore, we think Comfy should start contributing to bottom line also, and that should help at the overall earnings for Amrit Anjan.
Cool. A little bit on Page Industries, given the recent weakness, Ashwin.
So Page again, the base was high last year. One is because the first quarter was kind of a washout because of the Delta wave. So second quarter, there is a lot of stocking which happened. So the base of second quarter last year was high. And also there is mask sales in Page last year, which obviously didn't come this year. So combination of two things, I think, should explain large part of the muted volume growth that we saw in second quarter. And also Page is undertaking a lot of changes in the dealer level, auto replenishment system, etc. So naturally, it will bring down the overall inventory in the supply chain at the distribution level. So Page is undertaking that journey over the last 2 to 3 years. So some bit of impact from that also. But the good thing about Page is that from being a men's innerwear dominant segment, now they are pretty much doing well in women's wear, in athleisure, etc. So remarkably better company than what it used to be 10 years. But there are some headwinds which we think is temporary in nature. But fundamentally, the company structurally the company is on a much stronger footing.
Ashwin, Fine Organics, do you reckon a similar story like Page after a superb run, sort of slowdown?
So Fine, obviously, first half numbers were too good. Like I think the EBITDA margin was around 24-25%. Long-term EBITDA margin is 18%. So I feel that it could sustain somewhere in the middle. So that is my expectation. So clearly Fine benefited because some of its competitors, particularly in the Western world, they didn't have palm oil inventory because Malaysia, Thailand, one is that it's a very far away kind of a country from Europe or America. And secondly, Fine had inventory in place. So it benefited because of the competitor didn't have inventory. I think some of these, as things are normalized, I think the supply from the competitor side will increase. But having said that, because of this, the supply crunch at the competitors, Fine has been able to make headway into some of the customers, which it didn't have any presence around 3 to 4 years back. So I think that not all the market share will go away, but some of the market share will remain with Fine. So I believe that some of the Fine will not go down to the long-term average margin, or growth, but somewhere in the middle between what it reported in first half and.
So Ashwin, you should tell Indian promoters, right? Don't grow your profits at a rapid rate. फिर कोई broker note लिख देगा कि अगला 2 साल आपका profit growth नहीं आएगा. People in our country have a povertarian mindset. ज़्यादा profit growth आता है, they can't take it. They have to write a note then saying अगला 2 साल profit growth नहीं आएगा. But on a serious note, this is why looking for high quality franchises, whether it is in Divi's in our larger cap portfolios or a Fine Organics in our small cap portfolios. This is why the exercise is so worthwhile. You're investing in companies who are building globe girdling dominance, right? So GMM Pfaudler or a Fine Organics. Fine Organics from every corner of the world has had companies calling up for the products it makes. I think profits are up 200% or some insane number, right? Yeah. So profits are up some 200%. Now a typical Indian person will say, boss, ज़्यादा बढ़ गया है, up to 2 साल profit growth नहीं आएगा. Marcellus will say, great franchise. We've ramped up as much as we can given market liquidity. If the shares come off, liquidity expands, we'll keep buying, provided Fine carries on strengthening its moats, allocating further capital to growth. Management has announced they want to grow the business. Their current capacity, Fine Organics' case, current capacity is maxed out. They're looking to grow the business further in Gujarat. We have little doubt that they will grow the business further in Gujarat. by setting up a new plant in Gujarat beyond the current plant that they have in the outskirts of Bombay. Given the strength of the moats, the new plant will also fill up in next to no time. One day the new plant will also get maxed out. Then they will expand further. Right? Divi's Lab has been doing this for 20 years. They IPO'd in 2002. Fine Organics IPO'd more like 3-4 years ago. Divi's is more advanced in its journey. Fine is in a more nascent state of its journey. But these are the sorts of companies that define high quality investing. Just that Divi's Lab में आज वो growth YOY अभी growth नहीं दिख रहा. So people are selling. Marcellus is buying. Fine Organics we ramped up heavily 7-8 months ago. And as those profits hit sort of that insane number, 200% YOY growth, and the plant gets maxed out, we will load up for in anticipation of the next layer of Fine's journey.
One other stock which hasn't gone anywhere has been V-Mart. We've seen both weakness in the share price and as well as fundamentals adjusting for the Unlimited acquisition. How do we see that panning out?
So V-Mart again, it faced headwinds because the raw material prices like cotton went up significantly around a year back, and V-Mart took price increase. And because it caters just like Relaxo to the bottom section of the lower income group people, so there is obviously hit on the demand. So as a result, when you look at the bottom exhibit, the sales per square feet, it is still not higher or equal to even pre-COVID. Actually, so that is purely because the demand has got hit. But having said that, the cotton prices have plummeted in the last 5 to 6 months, and V-Mart has passed on that benefit to the customers in terms of lowering the price. So we think that the demand should start coming back. Already our channel checks are suggesting that incrementally things are getting better. So nothing again here, we think it's again temporary phenomenon, but nothing structurally. Structurally, we think that the company has improved significantly because by acquiring Unlimited brand of stores, it has now got a foothold in South India. And also Unlimited has done pretty well. I think when V-Mart took over Unlimited, the EBITDA margin used to be kind of mid-single digit. In the latest quarter, I think they reported almost more than 10% EBITDA margin. So clearly within a year, V-Mart has been able to turn around Unlimited. And also they have plugged a very important gap that they have on the technology front. So they acquired a LimeRoad, I think a couple of months back. So that also fortifies V-Mart online presence, etc. in the digital world. So fundamentally, the business structurally has improved significantly, but obviously the last 2-3 quarters numbers have got impacted because of the increase in the decrease in the demand.
So Pramod, Ashwin, folks, we need to run off at our end. But before I leave, I just wanted to sort of leave you with another nugget. We travel a lot, which is one of the reasons I have to head off to catch another flight. We travel a lot, and in the last month or so, as the worst of the war-driven inflation has tapered off, as Ashwin was showing, right? The worst of the war-driven inflation has tapered off. We are seeing a whole bunch of positive things which are going to get reflected, we reckon, in results in the final 3-4 months of this fiscal. Most notably, this whole destocking piece, the inventory destocking piece, that seems to have changed for the better. On the back of solid job creation in the formal sector, in the white collar middle class sector, we will see demand pick up. As Ashwin is saying, given that the worst of input price inflation has ebbed off, you read in the newspaper, CPI inflation is now back within the RBI's comfort range. As the worst of input cost inflation, whether it is cotton ka inflation, petrochemicals ka inflation, companies like a V-Mart, perhaps even a Relaxo or Amritanjan, they'll be in much better position to get affordability back in our prices. You've got to understand that these companies sell to poor people. V-Mart is selling clothes of 150 to 100 rupees ticket size ka, and Amritanjan is selling, cost-efficient pain relief solutions for the masses. And similarly, Relaxo ka Hawai Chappal segment, which is where they've been beaten up, was typically a 70, 80, 100 rupees ka chappal. So these sorts of companies are selling to the masses. It's asking a little too much of them to say input price inflation 30-40% बढ़ेगा, You guys hike your prices by 50% and still create an affordable product. That's sort of outside the realms of logic. As affordability returns in these products, we reckon demand is coming back. And I think we'll see that in a range of results for Q3 of this year. So thank you for giving me an opportunity to speak today. Pramod, Ashwin, back to you.
Thank you. Thanks, Saurabh. Have a safe flight. Ashwin, there's one question on an exit and also related to holding periods. Gujarat Ambuja Exports Limited was a rare quick entry and exit on Little Champ's part, where most of the other stocks have been there almost since inception. How do you see that instance? Does it have a bearing on holding periods that we intend?
Yeah, yes. So I would say that was kind of an aberration than the norm. I think folks who have invested in LCP since the beginning would know that it's kind of a very short period. We usually don't kind of exit in short period. The reason was that simply we want to have the best 16 stocks in the portfolio in terms of the gap between the intrinsic value and the current market price. So when we keep on researching on, we always have 4 or 5 stocks under research. So once we formed a view on Vijaya, Vijaya was scoring higher than that of Gujarat Ambuja, partly also because of the reason that there was a run-up in Gujarat Ambuja prices. It went up from 200 to 300, whereas the market, in fact, was in a downturn during that time. So in terms of upside, the Vijaya was having much more upside compared to Gujarat Ambuja, and hence we took that call of exiting, because we want the best 16 stocks in terms of the upside that they can generate in the portfolio. So again, want to reiterate that was kind of an exception. Usually will not see such things happening in the portfolio.
There's one rare question about accounting issue with one of our stocks, Garhware, question about related party transactions. How do we see that, Ashwin?
Yeah, I think some of you had written to us before that, but I think these transactions are not very significant. So I think not more than 5% of the total net worth, etc. So transaction itself is very limited. And also all the like typical classical red flags that could be there are not there in Garhware. For example, it's a cash generating company, very significant, generates a lot of free cash flow. In fact, to the extent that now it has 600 crores of cash in the balance sheet. So that itself gives us a lot of comfort regarding accounts. Any company which is cash generating, by default, usme chori nahi hota hai. And second is the promoters also not involved into any other businesses. So all their investment, all their focus is there on Garhware Technical Fibers. So we didn't kind of looking at the overall picture, don't see any kind of issues. Even in the latest annual report, I don't think that number itself is edging up. That number remains very insignificant compared to the overall capital employed or overall revenue or overall net worth. That number remains very significant. So we are not, but obviously we'll keep on looking for, as annual reports come, we'll keep a close watch out on how this number is shaping up.
Right. There's couple of general questions around why we are so public with our portfolio names. I think we've been asked this question in the past. We've answered this as well. Look, our intention has been to be as transparent as possible on what we are doing with your investments, and therefore, not only do we list the portfolio names, we're pretty much giving you the investment hypothesis as well. I think somebody has also asked a follow-up question, the answer to which Saurabh alluded to is, in that case, why bother investing with Marcellus and paying the fees? Why not copy the strategy yourself? As the experience of the last 12 months suggests, it's not that easy. Knowing what stocks to invest in is not going to make the difference. You should also know why you're invested with these stocks, and to be able to hold it through thick and thin is easier said than done. It requires a professional like Ashwin, who's been doing this for years to do it. Having said that, if people manage to copy it and manage to hold on to the behavioral aspect. I think good for them. We have no issues. We just want to help our clients who don't have the time to do these things, deliver a good return on their savings. Lastly, Ashwin, I think somebody's asked the right question. Given the performance of these portfolios, Rising Giants, particularly to a lesser extent, Little Champs over the last 12 months, does it mean that these portfolios are available at extreme discounts at this stage? I know we don't make any predictions from a short-term perspective, but to the extent that your numbers, your charts showed that the fundamentals have been ahead of stock prices, there might be a message in one of those slides. I think you did show a slide where in the past, when such drawdowns have happened, what has happened to the stocks in the ensuing few years and months.
Yes. So obviously, in hindsight, now I know that the stocks have returns have not been great for the last 1 year. Whereas actually, in the preceding slide showed that the fundamentals at the portfolio level still EBITDA was up 14%, 15%, 16%. So definitely, when you put a simple equation, a numerator आपका सस्ता हो गया है, denominator actually, denominator is basically expanded. So obviously, the stocks have on a valuation basis have become cheaper than what they were around a year back, and yeah, I think Rising Giants, both Rising Giants as well as Little Champs, we think they are, from an investor perspective, I think a much better place than 12 months back.
Yeah, so like I said in the beginning, Little Champs is not open for investment. You can register your interest with us by writing into sales@marcellus.in. We will reach out to you as and when we have an opening, but Rising Giants is open for subscription. Again, you can write into sales@marcellus.in and subscribe to the portfolio anytime. So that's it for now. Many thanks to all of you for dialing in, and you can access the recording on our YouTube channel as well as on our website. Hope to see you in our next webinar sometime very soon. Thank you. Thanks, Ashwin.
Thanks, Pramod. Wishing everybody a happy New Year in advance. Thank you.
Happy New Year, folks.